Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 growth tech stocks to consider buying at what could be pretty bargain prices ahead of their earnings results, which are due out next week for all 3 of the companies we're looking at today. But before we get into everything, remember to subscribe and leave a review wherever you listen to our podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these 3 stocks, it's good to just take a picture of the broader market since I talked about bargains, which obviously means things are not going well so far in 2022, as I'm sure most of you listening understand. So we're going to just take a quick overview of everything that's going on. So if we look back to this past Tuesday, so just a couple of days ago, stocks really plummeted with selling across the board. Wall Street was dumping everything from Tesla to Caterpillar to Nike. And this came as the market was awaiting the start of the really, really heavy part of first quarter earnings season, with results due out this past week. We've already seen, or this current week, from the big giants. We'll touch on in a little bit, actually. But so we saw the Nasdaq fall 4% on Tuesday, and the Dow drop 2.4%. That huge drop, which was driven by the Nasdaq, extended what was really a rough month of April after a really nice bounce back in the back half of March. And the tech heavy index is now, or was, it's bouncing back today, was at new 52-week lows on Tuesday and back into bear market territory. It then was pretty much flat on Wednesday, so flat yesterday, and the S&P 500 amid that also fell into correction territory once again, and it was down about 17% at one point yesterday. And it was then barely in the green over the last 12 months. So the selling comes amid heightened fears about rising interest rates, which have been on everyone's mind, soaring inflation, economic setbacks that could be made much worse by the massive COVID lockdowns that are continuing to happen in major Chinese cities. That said, we also then saw the U.S. economy shrink 1.4% at an annual rate in the first quarter. This data came out Thursday morning. This came amid as all the things we've talked about: supply chain disruptions, rising prices, all of this. So the U.S. decline in gross domestic product marked a pretty big reversal from what we saw was a 6.9% annual growth in the fourth quarter. That said, the first quarter was the weakest since the spring of 2020, and that was obviously the COVID pandemic lockdowns that sent the U.S. economy into a deep but very short recession, and we've bounced back in a big way since then. A big factor for the decline in the first quarter of 2022 was the widening trade deficit, meaning the U.S. imported far more than it exported. That said, which is a good sign, the consumer spending, which is the main driver of the U.S. economy, actually rose 2.7% in the first quarter, which was actually a slight acceleration from the end of last year as well. So some positives within a broader downward number for the first quarter. So with this in mind, Thursday got off to a somewhat okay start. Then we started to see stocks fall again today, and then we've ripped higher in the last couple hours as I'm recording this. The Nasdaq and the S&P 500. Let me look real fast. As I'm recording this, the Nasdaq is up 2.7%, and the S&P 500 is up about 2.3%, and the Dow is up about 1.8% around midday on Thursday. So people, maybe we're finally seeing buyers start to step in again amid all of this, these beaten down prices. So we'll see where we go from there, and this is what we're going to do when we talk about these stocks we're going to talk about next. So we've seen the busy part of the first quarter earnings season really kick off on Tuesday when we saw Google parent Alphabet report and Microsoft, and then we saw on Wednesday Meta Platforms, formerly known as Facebook, which still a lot of people call it Facebook, report alongside PayPal and some other big tech names, and obviously many other market movers in different areas of the economy. We saw Facebook shares climb 17% so far today, ripping higher after what's been a really brutal 2022 and long, rough stretch for Facebook. And then the big 2 reports today in the tech world are Apple and Amazon, which are due out after the closing bell Thursday. So far as of Wednesday morning, this is the most recent figures I have, we had about 180 S&P 500 companies that reported their first quarter results, with total earnings up 1.1% on 11.4% higher revenue, with about 81% beating EPS estimates and 73% beating revenue estimates, with about 63% beating both. That said, the Q1 EPS and revenue beats percentages are at its lowest levels since the second quarter of 2020 for this same group of companies in the S&P 500. So we're back to those COVID lows in terms of beats. So looking at Q1 as a whole, the S&P 500 is expected to see its earnings climb 6.6% on 11.1 higher revenues. The earnings growth for the quarter would drop to just 0.5% on an ex-energy basis, so without those energy companies that are seeing a big boom from rising oil prices. Also, it would improve to plus 13, so up 13.3% on an ex-finance basis. So we've seen some of the big Wall Street banks report rough earnings with some loan loss reserves out there. And then if we look at the full year for 2022, we're calling for about 8.7% earnings growth and 8.2% higher revenue growth. This would come after 50% growth on the bottom line last year and 17% top line growth, which came after, obviously, you all know, a rough year in 2020. And then we're calling for more growth, 9.6% top line growth in 2023, 8.1% top line or bottom line growth, for both of those figures in 2024. So some 3 straight years of between about 8.7 and 9.6 and 8.1% earnings growth, which is a great sign on top of what was a massive year last year, and then revenue growth to go along with that as well. So with this all in mind, investors might still want to take a chance to buy stocks at the moment. With all the things that are going on, we're down about 20% for the Nasdaq still. And if you're a longer term investor, things could always fall further. But if you have a long outlook of, say, a year, way beyond that, if you're thinking about investing for 10 years, you don't necessarily need to be worried about trying to time things by 6 months or 6 weeks or anything like that. So if you're bullish about stocks in the long run and you want to hold these stocks, we're going to look at 3 growth-focused tech stocks that have been hammered, that are worth maybe considering ahead of their upcoming earnings results next week. And the first stock up of this list of 3 stocks that fit that bill is Shopify, which trades on the ticker SHOP, so just shop. And the company is set to report its Q1 results before the market opens next Thursday, so a week from today on May 5th. So Shopify was a huge Wall Street star way before the pandemic, as businesses of all kinds turned to the company for all things e-commerce. Obviously, the stock has started tumbling since it hit records in November. Then it fell much further following its Q4 release in mid-February. And as Wall Street has sold growth-focused stocks recently, and the company provided a slower forecast than expected in the fourth quarter. This stock has continued to plummet amid the broader selling and especially of all growth names, and it's starting to approach rather attractive levels. So before we get to that, let's just jump into a little bit of what Shopify does in case anyone doesn't exactly know. So Shopify provides what it calls essential internet infrastructure for commerce. Pretty straightforward, including everything from site design and marketing to payments and shipping. They help companies do all of that. The company makes money from recurring subscription fees and tons of various add-ons that help people run many core business functions. The company's point of sale products and software have also gained momentum, while it's trying to slowly create a more unified approach between in-person and digital shopping. Because even though e-commerce is the growth factor and people keep talking about the death of brick and mortar retail, that's a little overblown at this point. So in terms of their overall reach, it took about 15 years from when the company was founded to October of 2019 for the company to reach its 1 millionth merchant added. And then it closed 2021 with 2.1 million merchants on its platform in about 175 countries. So it took 15 years to get to 1 million, and then it took about 2 years to get to 2 million. So massive growth, actually less than 2 years, because it was October of 2019, and then it closed 2021 with 2.1. So massive growth, obviously, during the coronavirus. And it's going to be hard to ever compete against those figures, but we'll get to that in a bit. The company offers different tiers. Some are aimed at entrepreneurs and small businesses, and then some are even aimed at really high volume merchants that run big businesses that are serving lots and lots of customers. Shopify, Amazon, and countless other digital commerce companies have still tons of room to grow, as we just said, or as I alluded to, in the sense that e-commerce is still not as big as maybe some would seem or some expect. It accounted for 14.5% of total U.S. retail sales in the fourth quarter of 2021, and that's up from about 10% in 2019. And if we look for the whole year in 2021, it accounted for about 13.2% of total retail sales, which was down from 2020 when it accounted for an all-time high of about 13.6. So still lots more room to grow. And then it also shows that brick and mortar is still far from fading away completely. Shopify did beat our Q4 estimates, and its total 2021 revenue climbed 57% to $4.6 billion, and its adjusted earnings were up 61%. This top line growth compares to about 86% expansion in 2020, and it averaged about 67% growth between 2019 and 2016 on the top line. So with this in mind, Zacks estimates are calling for another 31% revenue growth this year in 2022 to climb from 4.6 to 6 billion, and then another 32% growth in 2023 to get all the way up to 8 billion. Obviously, percentage-wise, these 2 years are going to mark a big slowdown compared to what they've done. Still, the company is expected to add about 1.5 billion to its top line this year, and then 2 billion more in 2023. For reference, it made a total of just 1.6 billion in 2019 and 1.1 billion in 2018. So the growth has been massive, and as you get bigger and bigger, the year-over-year percentages just get harder to look like eye-popping figures. Unfortunately, its adjusted earnings are projected to fall 50% year over year to $3.19 per share. This came after that big year last year, and then they are expected to bounce back in 2023. The company is obviously focused on improving a lot of things, and they're taking the opportunity to do that right now. So the company is focused on improving its fulfillment network, which they want to have a goal of being able to offer fulfillment services to 90% of the U.S. With 2-day affordable shipping goals. So they're just trying to be able to be more efficient on their own. They're trying to roll out all of these delivery options as well. So this is taking up some capital. The company expects to spend between 200 million in 2022, outpacing its spending on physical assets from the previous 2 years combined. Shopify also said it plans to spend roughly $1 billion over 2023 and 2024, leasing new warehouse hubs throughout the U.S. to ramp up all of these efforts. And it's also trying to increase its merchants or grow its base outside of North America. So it's increasing its marketing spend as well. Shopify currently lands a Zacks rank number 3 hold, and some of its earnings trends, I will say, are pretty rough, so that the company's trending in the wrong direction in terms of its earning estimates revisions. So before reported, we won't even consider that, but the things look a lot worse than they did on the bottom line. So 60 days ago, we were calling for $3.70 per share, and now we're calling for $3.19 per share in 2022. And we were calling for $5.65 per share for 2023 60 days ago, and now just about $4.74 per share. So a decent decline. And then the most recent updates we have and most recent earnings estimates are way below the current consensus. So that could say, if you're worried about buying right ahead of earnings, that could caution you to perhaps not, because they could maybe come way below with the most accurate estimates, which are the most recent estimates, often coming in far below the consensus. And the company failed to beat our bottom line estimates in the third quarter, and it topped by just 2% in the fourth quarter after what were massive blowout quarters on the bottom line way before that. So investors are obviously worried about high inflation and consumer staples weakening demand for non-essential goods, like many of those sold on Shopify. But the company still operates a really solid business long term, and it's not going out of style anytime soon, as we just showed with their revenue growth figures. Plus, it has a really strong balance sheet, about $8 billion in cash and equivalents, $13.3 billion in total assets, versus just $2.2 billion in total liabilities. So the company is clearly ready to keep expanding its growth. They're doing that right now. and they might be able to grow into new areas that we can't even think of even at the moment. So it might be a time to start nibbling at the stock, maybe not go all in, especially ahead of the report amid all of the volatility. And there's also the possibility that you could pick up the stock for an even cheaper price in terms of the actual just price tag per share, because the company earlier this month proposed a 10-for-1 stock split. Under the proposal, the co-founder and current chief executive would receive a new, quote, founder share that combines his existing supervoting Class B shares and will increase his voting power from 34% to 40%. I'm not going to get into all the details, but there's still the possibility that the company could roll out a 10-for-1 stock split. Stock splits have become really popular with a lot of these tech companies. Apple's done it recently, mid the last 2 years. Tesla's done it. And this is just to make their stock price more attractive to a wider swath of investors, because it's hard to accumulate a larger position if your stock costs $1,000 per share. It's just going to scare a lot of smaller retail investors off, which a lot of those have joined the market in the last 2 years. So in terms of its actual price at the moment, Shopify stock skyrocketed from $70 per share back in 2017 to $1,700 in November of 2021. And then that's when everything started to crumble with the Nasdaq, and everything growth was being sold. So the stock has plummeted 75% since then, and it's now down 33% in the past 2 years. So in fact, it's trading below where it was before the initial COVID sell-off. So if you were bullish on the stock as a long-term e-commerce play, you can now pick it up for where it was trading before the pandemic, when more businesses were forced to reevaluate, and e-commerce is more of a important thing than it was before. So despite that drop, the company is still trading at a really sky-high forward PE of 135 times earnings. And its PEG ratio, which is its PE divided by growth, is still at 4.2, which is down from a whopping 66 last April. Its median over the past 12 months of 34, so come down in a big way. This compares to Amazon, which is at about a PEG of 1.9, and the broader internet service market of about 0.75. This also marks new lows for the company. So these growth-focused companies, you don't necessarily want to look just at the price earnings, because they're trying to put all of the money back into the business, continue to grow and grow and grow. So to see its PEG ratio come down is nice as well. And it's trading in terms of price times forward 12-month sales, it's trading at 7.9 times forward 12-month sales, which is right about its lowest point, actually like right at its lowest point of the last 5 years, way below even the COVID lows. So certainly getting to be a more enticing price if you're bullish on Shopify. Obviously, those might be rich for a lot of people's blood, especially with higher interest rates, which is why the stocks have been hit so hard. Obviously, if you are a risk taker, you could consider maybe buying it on the possibility that it could have a huge pop if it's able to impress Wall Street next week with either a strong report or stronger guidance. But if it does fall much further after the report, you could get it at even more of a steal. But if it continues to fall, maybe it's one you want to stay away from for now, because maybe it's just fallen out of favor for reasons that we can't even see at the moment. But after all we've gone over, it certainly looks like it might be worth putting on your radar if you were at all bullish about Shopify and their broader e-commerce growth. And that top line expansion is still going to be there as they put all the money back into the long-term viability of the business. And another stock we're going to look at today that falls under that same growth category that's been hit really hard is Block, which is formerly Square. So it's still hard for me to get used to saying Block, but it's the same company trading under the same ticker, SQ. The name change went into effect in December. The company is also set to release its first quarter 2022 results next Thursday as well, May 5th. Like we did with Shopify, we're going to just go over the broader business and everything going on. So Square, or Block, started over a decade ago by selling technology to help tiny businesses process credit card transactions from their smart devices. This became as everyone had an iPhone or an iPad, and you wanted to take credit cards wherever your small business was. Today, the company is at the forefront of the ever-growing fintech or financial technology industry, and its sights are set on becoming an all-encompassing app and ecosystem for sellers and consumers. Block is light years beyond the firm that sold those small smartphone and tablet connected credit card readers. It's now expanding into point of sale offerings, like much bigger ones, broader payment software and infrastructure to support that, business loans, peer-to-peer payments, Bitcoin transactions, and more. It's trying to be a wide-ranging financial service firm for both sellers and consumers. This includes Square banking offering for U.S. sellers, savings and checking accounts, loans, all of that. Variety of point-of-sale systems for in-store transactions, and the back-end online payment technology to support all of that. And the company's also really caught on in the vital peer-to-peer market with its Cash App that competes against PayPal and big banks like JP Morgan, where consumers are now directly depositing checks and paying their friends digitally, family, and more. The company wants to be able to start paying at retail locations with the Cash App. They hope that just people start having the Cash App as almost their digital bank account, as this part of this broader fintech ecosystem where you start keeping your money in Block for the long run. The Cash App also allows users to buy and sell Bitcoin, stocks, ETFs. That can help the company compete for investors against the likes of Robinhood, which has some long-term upside there. And so the goal is just to be able to send money and receive money instantly, and then the company makes money from the Cash App if you kind of want to speed up your bank deposit instantly in various other ways. If you want like more instant cash and keeping a balance and stuff like that on there, that's how they're making money on the Cash App. Square is clearly well on its way to becoming that holistic financial services firm for both consumers and businesses to spend, keep, and invest their money. The company also in early August, so last August, announced its entry into the fast buy now, pay later space with its planned acquisition of Afterpay. And that deal actually, which is valued at about $30 billion, closed at the end of January. So Afterpay is one of the leaders in that short installment payment options for e-commerce shoppers to purchase, and the purchase is part of that broader plan to integrate within its seller business and its Cash App. So for those of you who don't know, buy now, pay later just allows you to, if you're on, say, a website like Home Depot or Nike, it'll say pay in installments. So if you're buying shoes, you could pay, if they're $100, you could pay in 4 $25 installments, and then they charge you interest on that and blah, blah. I'm not getting into the details, but that's the basics. Buy now, pay later. They paid about $30 billion in an all stock deal for Afterpay, closed earlier this year. They want to roll that into everything. So this is just part of their big push to be a massive fintech company. They even have deals where with TikTok, that huge social media company, that will allow people on TikTok to start selling things, because lots of people on TikTok are selling things that have directly from the app. So now let's look at some growth. Block steadily expanded its revenue since its late 2015 IPO. It averaged growth of about 39% between 2016 and 2019. And then just like Shopify, 2020, things went bonkers. The stock skyrocketed, the revenue skyrocketed, 102% from 4.7 billion to 9.5 billion. And then it posted another 86% revenue growth in 2021 to hit 17.7 billion, with its adjusted earnings up 104% as well. The company topped our Q4 earnings estimates back in February by 42%, and it's been able to grow its larger businesses at a really nice clip, which is helping. So yeah, that revenue growth has just been massive. But like Shopify, its earnings outlook is trending heavily in the wrong direction as economic growth slows and people maybe slow down in their spending. So over the last 60 days, its FY 2022 consensus earnings estimate is down 23%, and its FY 23 is down about 11%. And its most recent or most accurate estimates are well below those figures as well. So like with Shopify, maybe be a little cautious about buying it right before earnings, just to know, because so much has changed since they reported their results 3 months ago, that things could be a little worse or a little better depending on how things go. So in terms of 2022, it's definitely going to slow down for the top line and the bottom line. So we're calling for just 7% growth on the top line to about 18.9 billion, but then jump another 27% to 24 billion. So it's set to add 5% to the top line in 2023, which is more than its entire 2019 revenue. Just to put things in perspective, with Shopify and Square, they're both just slowing year over year percentage wise, but still growing at a massive clip just after those 2 years of just insane overnight growth they could never hope to replicate. We're calling for a 39% dip on the bottom line this year, and then to bounce back in a big way to essentially where they were in 2021 and 2023. The company lands a Zacks regular hold at the moment, and Wall Street remains really confident in the stock long term, with 70% of the brokerage recommendations that we have sitting at strong buys. So we have 19 strong buys, 3 buys, and then 5 holds. So nothing below a hold. The company has a pretty solid balance sheet at the moment. It has $14 billion in total assets, $5.3 billion in cash, versus $10.6 billion in total liabilities and about $5.4 in current liabilities. So not that big cash cow, but still a pretty solid balance sheet. And now we're going to move on to the price. The stock is up about 670% since it went public in late 2015. This does include a pretty rough stretch that saw it fall from its then highs in 2018 to the COVID lows, and it didn't return to those 2018 levels until that massive COVID comeback. SQ is up about 52% in the last 2 years, but it has fallen about 65% from its August records of around $280 per share. And the last time I looked Thursday morning, it was trading at around $98. Plus, its current Zacks consensus price target of $214 per share marks 114% upside to those current levels. And like Shopify, its valuation is still really sky high. So it's a firm growth company, which is a big part of the reason why it's been hammered mid rising interest rates. So it's trading at 110 times forward earnings, and its PEG ratio sits at 4.6. It's also rather high in terms of that PEG ratio, though it is down big from where it was, and it compares relatively straightforward with some other massive growth companies, though it is still high compared to that broader internet service market, which is at 0.75. And then if we look at the price to sales, it is trading at 2.8 times forward 12-month sales, which is right near those COVID lows. So back down to what could be considered pretty solid entry point for this stock, just beaten down. So if you're a value investor who's looking at the earnings ratios, maybe not the best, but if you're looking at these growth stocks in terms of PEG and forward sales, certainly looking at pretty enticing levels. So I would say the same thing I did with Shopify. Maybe hold off until after the report, see how Wall Street reacts. But if you're bullish, or you were bullish 2 years ago, these prices and levels are pretty attractive and might be worth taking a chance on. Square/Block. I keep saying Square, but it's Block, trading under ticker SQ as a longer term buy and hold. And then the last stock we're going to look at, I'm going to try to be a little quicker with, and that is Datadog, which trades under the ticker DDOG. And like all of its peers on this list today, it's set to release its first quarter results on Thursday, May 5th. So Datadog is a cloud software firm that enables its clients to monitor the performance of databases, servers, apps, networks, and more. The company went public in 2019, and the firm has carved out a really nice section of the widely popular and crucial area of software. So it's one of the fastest growing offshoots of the cloud computing and software space, as companies focus on what they call the observability of their software and their tools. There's just so much data and so much software that people need to really understand what's going on. So this helps IT departments keep tabs on the health of their various networks and all the things we talked about, servers, apps, databases, and all of that. And that's what Datadog's business is, with the overall IT spending poised to accelerate coming out of the pandemic and going forward for years and years to come as we live in a digital age. It certainly is a company that is poised to grow there. So the company closed 2021 with stronger large customers. So it finished the year with 216 customers who brought in 1 million or more in annual recurring revenue, up from just 100 before that. So it gained over 100% more. Datadog also had about 2,100 customers with annual recurring revenue of $100,000 or more, which was up 63% compared to the end of 2020. So some key growth in terms of those larger customers. The company has also landed deals with key players such as Amazon Web Services and others. And then in terms of revenue, the company climbed 70% in 2021 from $600 million to $1.03 billion, which came on top of 66% growth in 2020. And then if we look ahead, we're calling for another 48% growth on the top line in 2022, and then 37% growth next year. It's going from $1 billion to $1.5 this year, and then going all the way up to $2.1 billion next year. So just ripping off big growth of about $500 million adding on the top line in back-to-back years. And then on the bottom line, we're calling for subdued bottom line growth of just 2% after a strong year last year, and then another 58% growth on the bottom line next year. And we should also note the company has a really strong history in the last 4 quarters of big bottom line beats. It's beat by an average of 120 or 125%, including 82% beat last quarter, which is always solid to see. The company also has a pretty solid balance sheet at the moment, and Wall Street's rather high in the stock. We have 13 brokerage recommendations coming in as strong buys, 3 more buys, 2 holds, and only 1 sell rating. So overall, Wall Street's still really high in the stock. And then in terms of its price performance, the stock's up about 240% since it went public. And the stock, though, is down about 40% from those November peaks, trading at around $123 per share, which marks 57. It has 57% more room to climb before it hits the current Zacks consensus price target. And obviously, like all these stocks as well, it's a growth name. Its valuation is really high in terms of forward earnings. And then if you look at forward 12-month sales as well, it's trading at 22 times forward 12-month sales, which is really high. But if you're a growth investor, the stock's gone on a big run, trading at levels higher than this. So over the last couple of years, it's traded as high as 51 times forward sales, and it's traded as the COVID lows were about 15, so it's trading at 22 times forward sales at the moment. So if you're a growth investor, you can handle those kind of multiples. It's trading at solid levels compared to its own recent history. Its median was about 33 over the last several years, so it's trading at 22. And Wall Street remains, as I said, really high in the stock. And with the Nasdaq sitting in a bear market, and we saw the big pop today, Datadog, Square, and Shopify certainly look worth considering as longer-term growth investments. Maybe growth is falling out of favor, but if you're bullish on tech long-term, which I think realistically all of us should be, you might want to consider these 3 stocks. But as I said, maybe don't play it right around earnings because the market's just been really volatile. You're seeing 20% swings in big, huge stocks. So something like Datadog could be thrown around even more. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.